The next document is just talking about different mortgages. It's called a mortgage on your terms. You can select, when you get a mortgage, you can select any term that you want, anything from 8 years to 30 years. I generally only write fixed rate mortgages. I believe that a fixed rate mortgage without a prepayment penalty so that you can pay as much as you want anytime is essential. And I don't think having an adjustable rate mortgage is a good idea right now because I believe interest rates are going to go up. So I would definitely encourage you as a fixed rate mortgage without a prepayment penalty and not in a balloon or anything that comes due at any time. And then you can buy a home without down payment assistance. We'll get into some down payment assistance, but as little as 3% down payment in a conventional loan. And if you have less than perfect credit, FHA wants you to put 3.5% down. So it's a Federal Housing Administration loan or government backed. I'm going to stop here for a minute and just field any questions so far. Sorry. A fixed interest rate with no prepayment penalty. That way you can pay as much as you want anytime and you'll never have a penalty for doing so. So when you buy a house, you can finance up to, on a conventional loan as a first-time home buyer, you can put as little as 3% down on a conventional loan. And on a government loan, as little as 3.5% down. And then we'll talk about how to combine that with a government program, to combine it with MSHDA, like a down payment assistance program.
I do have a question about that. How do you qualify for FHA?
For FHA in general?
Yeah.
It's very, very loose qualifications. So it's the simplest loan to get qualified for. Your best bet is to have a 620 credit score. You can get approved with a 580 credit score. However, the interest rate is a 0.5 percentage point higher. So I'd rather help you get your score to 620 because it helps your interest rate and closing costs. So 620 minimum credit score, although down to 580 is acceptable. You need to have a documentable income supplied by W-2s and tax returns and pay stubs. If you have not been on your job for 2 years or can't supply a basis of a 2-year employment history, your education counts. So we can build a 2-year job history based on, like I bought a house the first month I was out of college because I have a degree. I got a degree, and that was 4 years of job history. And then my job at ZBART, rust proofing, was my position, and it was a salary, so it was a stable income, and so I got my mortgage. I graduated in May, got my job in September, closed on my loan in November. So you don't have to have 2 years on the job. You don't have to have 2 years in the same job, although it's helpful to have this 2 years in the same line of work. When you have very, very good credit, when you have good credit, we'd go to conventional, which doesn't have as many sticky points on jobs. Like you could be on a different line of work. You could be a truck driver and then have gone to be a phlebotomist or something due to your education or your job transfer. And conventional will read that, and if they give an approval, then it doesn't matter. Does it?
Does that look bad when you switch industries?
I have a client that is switching. Sometimes, yes. Generally speaking, if you have 4 or 5 job changes in 2 years, you have to build stability by staying on the job for 6 months before you can get a loan. I have a client that is very unstable in his job, and he's had 5 or 6 job changes. The underwriter has agreed in FHA, I looked at the handbook, 6 months on the job, and they'll be able to get a loan, which is really encouraging. Moving 1099 income is considered self-employed. So you want to think twice before agreeing to take a job that's a 1099 position unless you're willing to stay there for 2 years and build tax returns before you get your mortgage, for sure. So, and it makes, so when you're self-employed, it's considered a type of self-employed. So when you're self-employed, let's say you're self-employed and you're a truck driver. I'll go back to that because that's the only thing in my brain right now. And then your truck driver wants to hire you and he wants to make you an hourly employee. Immediately you become able to do a mortgage. Immediately, because you have W-2 employee, you have an employer, and you have reliable income, and your taxes are taken out. Now, if you do the opposite, if you're a W-2 employee, this happens often, and your employer changes you to 1099, you suddenly become self-employed, and you're no longer eligible for a mortgage, for a loan. I'm not thinking that that's anybody, but that's just for information. Any other questions? So when we sit down and we go through an analysis together, I go through payments and out-of-pocket costs. I explain the loan program specific for you. There's so many cool loans. Like there's a rural development loan. If you want to live north of 26 Mile Road or in the more rural areas in St. Clair County, for example, there's a zero down loan program that is 1/3 of the PMI insurance for living a little bit more in a rural area. It's a wonderful program. If you're in military or you're ex-military, like a veteran, there's a zero down VA loan program called a veteran loan. So those are 2 zero down loan programs. Aside from that, there is not a zero down loan program. The lowest down payment that you can do is a 1% down payment.